Hello, class. Our team, consisting of Marcus, Melanie, Shelley, Milan, and Rafaela, have formed a firm valuation for Apple. We hope you enjoy our video presentation as we thoroughly explain our analysis.
Have you ever considered buying a company? In this report, we considered what it would take if we wanted to buy Apple. Many of us know that Apple is among the leaders in the technology industry. In 2012, Apple was actually declared the most valuable company in the world based on its market capitalization. In this report, we looked at another way to value Apple. We started by looking at Apple's financial statements for the past 3 years and forecasting data for the next 10 years. Then we calculated the weighted average cost of capital for Apple, which was 9.87%. Based on Apple's free cash flow, which we found in the financial data, and using the calculated weighted average cost of capital in the discount cash flow method, we determined that Apple's current value is a little over $1.2 trillion. We played around with a few scenarios and determined that changing the weighted average cost of capital is actually the most effective way to impact Apple's share price. And we found that currently the value per share of Apple is $221.64. The price per share at the time of drafting our report was $172.91.
And here is a quick overview of what we will be discussing in our presentation. We will first provide a brief introduction on the history of Apple, then we will discuss the pro forma financial statements, and after that, the weighted average cost of capital. Apple's free cash flow and firm valuation will later be discussed. Following is the scenario analysis and a brief conclusion on our overall findings.
Apple, leader of the computer technology industry. Apple's variety and product availability has created a massive level of brand awareness and demand. Apple offers a wide range of products such as the Mac desktop computers, laptops, iTunes, iPods, iPads, iPhones, and the Apple Watch series. Apple's hold on consumers' demand can be observed best when customers rush at the latest version of an iPhone paying nearly $1,000. But it's because of Apple's pioneering technology and product sophistication that it is able to demand the market in this way.
The first step in determining Apple's value was to create pro forma financial statements. Apple's financial data for the past 3 years was obtained from SEC filings and used to forecast the next 10 years. We assumed 10 years to be the horizon point at which Apple enters a period of stable growth. First, financial data from Apple's income statement and balance sheet was entered into the spreadsheet. In some cases, Apple's financials were more complicated, so multiple rows were combined into one other row for simplicity, such as other current assets. Once the past 3 years' data was entered, statistics were run and used to forecast the next 10 years. In most cases, the average of the year-over-year change was used. For example, to forecast sales, we calculated the percentage change from 2016 to 2017 and the percentage change from 2017 to 2018. Then we averaged those two percentages, which resulted in 11.08%. That 11.08% was then applied to 2018 sales to forecast 2019, and so on. Some rows in the spreadsheet are dependent on others, like the cost of goods sold, because they're relative to sales. To forecast COGS, we calculated the average COGS to sales ratio for the last 3 years, which was 61.37%. We then applied that ratio to future sales to forecast COGS. Some items which would not make sense to predict based on history, like the number of shares outstanding and liabilities, were assumed to remain at current levels for the forecasted period. In these cases, a single line item was adjusted so that the balance sheet would remain in balance. For example, in liabilities, deferred liabilities and other obligations were assumed to remain the same. Then, long-term debt was derived by subtracting current liabilities, deferred liabilities, other obligations, and total equity from total assets. Retained earnings were similarly calculated by subtracting the forecasted dividends from net income. Finally, the projected external financing needs were determined by subtracting the current level of long-term debt from the projected long-term debt for the following year, and so on.
In this section, we are going to review the weighted average cost of capital, also referred to as WACC. To give you a brief overview of what WACC is, it is the expected rate of return on a portfolio of a firm's outstanding debt and equity. WACC is calculated using the data from the firm's financial statements, such as income statement and balance sheet, and information from the industry market, such as the beta and risk-free rate. An increase in WACC indicates a decrease in valuation and a higher risk. Having high risk signifies greater uncertainty towards a return on investment. The data needed to measure WACC consist of cost of equity, equity weight, cost of debt, debt weight, and interest expense. In this slide, we will discuss the cost of equity, value of equity, and equity weight. First, we have the cost of equity, which is the expected rate of return of common stock demanded by shareholders. We used the capital asset pricing model, CAPM, also referred to as the expected stock return, to calculate the cost of equity. That formula is risk-free rate, which is 2.594% plus the beta of 0.99 times the difference of the market return of 11% and risk-free rate of 2.594%, calculating 10.92% as the cost of equity. Next, we have the value of equity. We use the market value rather than the accounting value. This is calculated taking the share price of $172.91 and multiplying it by the number of shares outstanding, which is 4,775, giving you 825,645 as the value of equity. Last for this slide is the equity weight. With the information we can now determine the equity weight of 87.82% by dividing the value of equity over overall firm value. In this slide, we will discuss the cost of debt, the value of debt, and debt weight. First, we have the cost of debt. The cost of debt is the opportunity cost of capital for the firm's debt holders. The data is found in the current year's income statement. We use the net interest expense and total debt to do this calculation. We take the average of the sum of 2018 net income expense divided by 2017 total debt, which is 0.0318, and 2017 net income expense divided by 2016 total debt, giving you 3.00% cost of debt. Next, we have value of debt. Again, we use the market value rather than the accounting value. However, we use data from the balance sheet this time. The current year long-term debt is $93,735. Is added to the current year short-term debt of $20,748 to calculate the value of debt of $114,483. Last for the slide, we have debt weight. This is calculated subtracting equity weight of 87.82% from 1, which is 12.18%. Now we are ready to calculate the WACC using the formula cost of equity 10.92% times equity weight 87.82%, adding the cost of debt 3.00% times debt weight 12.18%, and multiplying that by 1 minus a tax rate of 22.82%. Finally, we have determined Apple's WACC to be 9.87%.
In this section, we are going to review two different areas, the free cash flow and firm valuation. So far, we have gone over the pro forma financial statements and the weighted average cost of capital computations. We're going to now use all that information to determine the free cash flows in the coming years with our ultimate goal of estimating the firm's value. To be more specific, the period of our future estimates will start in 2019 and will end 10 years later in 2028. Before we get to those numbers, we will first go over some key notes to consider. Free cash flow is the amount of cash a firm has after paying their operating expenses and capital expenditures. This process is very important because this will lead us to the final task of estimating the firm's valuation. A firm valuation is a process used to determine the potential future value of a business. They are typically used by corporations when they're trying to get a sense of what a company will be worth in the future. This process usually happens when there is a consideration on purchasing or selling a company. Now that we have went over some general information on the meaning behind free cash flows and firm valuation, we will now incorporate some data that is specifically regarding the chosen company of Apple. Here we're going to review the free cash flow segment for Apple. The table in this slide is just a small segment in our free cash flow tab found in our Excel spreadsheet. So in this particular case, we used the discounted cash flow DCF method to determine a firm valuation. There are several other methods of conducting a firm valuation, but this one in particular allows us to estimate the value of Apple through future investment cash flows. Estimating the value is done by projecting future cash flows, found inside the red box, and then discounting them through their present value and weighted average cost of capital, both inside green boxes. The present value estimation helps us determine the free cash flow present value for a period of years up to the terminal value. The terminal value is the value at a future period of time when a stable growth rate is expected. In this case, the stable growth rate is expected after the 10 years. Once the 10 years have passed, we are suggesting that there will be a 2% stable growth rate for Apple. There are some factors that help us determine the terminal growth rate of 2%. The current market's average inflation rate is 2%, but we're also taking into account the specific company we are analyzing. In this case, we're suggesting that Apple has not hit their maturity stage yet. After the 10-year growth period, Apple may reach their maturity stage, so at that point, the stable growth rate of 2% will make more sense. Now we're going to review the firm valuation segment for Apple. So to obtain the firm valuation, still using the DCF method, we're going to add the present value of the terminal value along with the collection of present values shown through the projected years. All of that is found inside the red box. Once we add everything inside of the red box, we get the total estimated firm value, which is the result inside of the green box. In addition to the total estimated firm value, these calculations also gives us some other estimated figures, such as the debt value, equity value, and the value per share. Debt value is the total estimated debt the company holds, and also tells us how Apple chooses to finance their operations. Equity value is the amount of capital Apple raises through the sale of shares in the company. Once we add the debt value and equity value together, the two values equal out to the total value of the firm. The final two figures on the spreadsheet are outstanding shares, which are the same figures found in 2018, and the value per share. Now we can compare the estimated value per share to the current value per share. To do this, we divide the total estimated value by the total outstanding shares. In the case of Apple, this came out to $221.64. This value is a lot higher than their current stock price of $172.91, but this is from determining an 11% growth rate for the next 10 years. The 11% growth rate is acceptable to suggest because Apple's firm is a pretty large size and we are forecasting into future years. It would just be too optimistic to believe Apple will continue on with an 11% growth rate. And like we mentioned before, Apple will eventually mature and move into a stable stage where we're suggesting the growth rate will drop down to 2%.
So for this section, we are looking at the scenario analysis of Apple. We see here that there are 5 different scenarios from which we were able to compare the effect that changing key financial assumptions had on Apple's value per share. We see that changes in sales growth rate, cost of goods sold, growth rate for terminal value, and weighted average cost of capital, whether the change consisted of a percentage increase or decrease, resulted in a boost for Apple's value per share. Take a look at, for instance, sales growth rate. By increasing the sales growth rate from 11.08% to just 12.08%, value per share nearly doubled. So by increasing Apple's sales growth rate, we can expect a significant raise in value per share. But then we see the ultimate benefit to value per share came when a scenario 5, Apple's weighted average cost of capital was decreased by a percentage. The value per share increased by 4 times its initial value, which is incredible. But we know that this is because by reducing the WACC, Apple would then increase the level of certainty regarding return on investments. On another note, and despite the findings of our scenarios, Apple's current stock price of $172.91 is considerably low. In other words, the expectations of the market for Apple are actually lower than what we found.
To bring to a close of our Apple firm valuation, we will briefly discuss our overall findings. The pro forma financial statements projected the sales growth rate to be 11.08% and the cost of goods to be 61.4% of sales. The growth rate calculated for Apple is above the estimated technology industry growth rate. Apple's WACC is calculated to be 9.87%, which signifies that Apple must pay investors 0.0987 for every dollar in return. The free cash flow and firm valuation for Apple provides an idea of what the cash flow is after operating expenses. The discounted cash flow method is also utilized to compute the firm valuation. The value of the stock is determined to be $221.64, which is higher than the current stock price of $172.91. In the scenario analysis, we attempted to increase sales growth rate, decrease cost of goods sold, increase the growth rate for terminal value, and decrease WACC. Decreasing WACC determined the best result of value per share, proving that WACC highly impacts the valuation of a firm. Apple's sales growth rate is optimistic. However, Apple is putting consistent effort to show that the estimated sales growth rate of 11.08% is realistic and achievable.
And this completes our firm valuation presentation for Apple. Thank you so much for listening.